Welcome to today's Corporate Venturing Insider series. Today, I'm very happy to have Jody Thelander with us, and I know she's going to share a lot of things that most of you are curious about. Jody, welcome.
Thank you, Nicholas. Glad to be here.
And so I was recently on your podcast, so this was really nice. Thank you again
Actually, you
for
were
inviting
recently on
me.
our webinar. We did a corporate venture webinar.
Webinar, yes. So, Jody, I always start by asking how someone got into corporate venturing. You are right in the middle of it, so maybe you could share a little bit of your background.
Yeah, well, thank you. It was actually a very step-by-step process. So I initially was doing compensation I was in San Francisco, and it was really sort of the go-go.com days back in the late 90s. And my firm was doing compensation for private companies that had raised venture money. And also we were at that time actually doing a little bit of everything, even some recruiting, and it was so happening so fast. But I noticed that all of the good stuff was going on in the boardroom, which was all around at that, for a private company around the cash and equity. So that's where the first sort of Thelander surveys and consulting started. And then from there, because we worked with all the VCs, it was a natural question, especially with my colleagues who are also my friends. It's a nice group of people would ask, well, what about my salary increase? What about my bonuses? What about, these other factors for venture capitalists? And there wasn't really much of a career track that way. The VCs were sort of this formidable group, but it was becoming more and more a career trajectory. So started doing the comp surveys for the VCs. And then I noticed that several of my VC friends were going to corporate venture firms. And that was sort of the next, what's a CVC and what kind of compensation do they have? And it really all just begged the question around getting into formalizing, as you and I have talked about, corporate venture as a career track and allowing the ability to compare and contrast. But it seemed really important to make sure there was infrastructure.
I mean, I think you've had the chance and the opportunity to see the rise of CVCs. I think you were a friend of the GVC for a while. And my understanding is it was a very small conference to start.
Yeah, I mean, James Mawson and Heidi Mason, Bell Mason Group. I know Liz is now in charge and does an amazing job. And of course, GCV is amazing as well, a great infrastructure and organization to support the industry. And we collaborated with them and the law firm DLA Piper at the time. And we sat in a boardroom at DLA down in Palo Alto and really talked a lot about what we just said, right? We looked at the venture data and the jobs, and we crafted what were the first comp survey to look at. I think at the time it was like 3 or 4 roles: the CVC unit leader, a senior investment professional, and then some version of like an analyst. And we sort of assumed like the CFO and the other jobs would be coming from the parent company. And we thought it would be so important as the other components, like the consulting and like Bell Mason does, to put a CVC together, and what GCV does for all of the players coming together, that the last component that we could help with. And obviously we had some insight in, because we only cover the private capital market, so we don't do any work that covers, like a traditional public company consulting compensation. So it was a perfect segue. We knew the other lanes that we wanted to compare and contrast to.
And I think part of it is reconciling two things that seem so different. You have VCs and you have corporations. It nearly reminds me of the book Men Are From Mars and Women Are From Venus. And one is about predictability, distribution law. One is about high returns but high risk, which is a power law. And compensation is very difficult to find the right match between the two.
You know this better than anybody, and I love your optics on it because you're very strategic. You're both strategic and tactical, because you understand the big picture. But then, obviously, at TDK Ventures, you do this every day as well. So you're really a leader in the industry that sets a tone, because that's what people want to know, sort of what's the best way, what way makes sense. And the truth of
Mm.
it is, you know as well as I do, there's not just one way. And it depends on what the goal is of the CVC and what type of team and what the parent company wants, because everybody wants something a little different versus VC, where I could say without a shadow of a doubt, everybody wants financial return as their number one priority. They may have some double bottom line, but no question, financial return is the biggest motivator.
Yes. So if I go back to the rise of CVCs, what do you think is the biggest change you've seen from even 10 years ago when it was starting to become something with GCV? And I think GCV is going to be doing their 10th event. So 10 years ago is probably the
Right.
right metric to today. What comes to your mind when you think about the big change, the high level changes?
The formality of the compensation and even just the role that CVCs play in the innovation ecosystem, and also the amount of wanting to be competitive. Some CVCs really want to be competitive with venture firms and have that true, I don't want to get too technical, but get into those long-term incentives like carried interest. And so it's become very formal and structured and competitive.
And part of it is also the number of job titles we discussed. So maybe this is a plug. We will put the link to the webinar we had last week. But part of it is the number of job titles, inflation we've seen in the last 10 years.
Yeah. I mean, there used to be, as we said, just a handful of titles. And then the CVCs were very smart to leverage the resources of the parent company. And this is something that you're obviously very familiar with. But for those of you that are listening, the strength of the CVCs is that whole business development role and optimizing the parent company's skill set and talent inside to the portfolio companies, because we know now that the private markets are staying private longer. It's harder for private companies to raise capital. It's harder for VCs to raise new funds. And the CVCs are in a very optimal position because they're sort of the slow and steady wins the day.
I like that. Can you double click on this? Because I think there's a golden nugget behind.
Yeah, the CVCs have, because of their comp structure, and if this makes doesn't make sense, I'm happy to elaborate. But the comp structure has a couple of possible components for the long-term incentive. One is corporate stock.
Hmm.
And another thing could be the shadow or phantom or some version of a synthetic carry. And then the other could be a true carry. But with all of that, nothing is happening fast, even for VCs, right? The carried interest vesting times now are heading up more than 10 years. I think CVCs probably always knew this if they were not on some fast track, because in some respects they had to be careful that the CVC person, the top person or the whole unit, wasn't bringing in more returns than the actual parent company, because that sometimes caused a little conflict. It was more about technology transfer and innovation.
Hmm. No, no, it does make sense. And if you think about career development, so there's compensation clearly, but in terms of career, when CVCs were very early, there was no such thing per se. And if you
Not
think about
really.
VCs, you don't really have a career development beyond analyst to principal to GP. But in CVC, it feels like there is many more paths, and you have platform teams on top of investment teams. So you do have quite a few differences that are quite fundamental with CVCs. How do you think about not just the investment team, but the rest of the team for a CVC?
It really depends on the CVC, because typically the investment team is more goal oriented in terms of selecting the portfolio companies and understanding the directive from the parent company, or if they're very separate from the parent company, they're structured that way, sort of what they're trying to achieve. And as you would imagine, the lower down you get in a CVC, the less impact they have on that strategic goal, and they're more tactical in terms of the day to day, so they're less focused on that long-term incentive.
And I want to double click on the tactical versus strategic. And most of the audience are already in CVCs or thinking about starting a CVC. So let's focus on those who would be thinking of starting a CVC. What do you think is a top tactic for them to think about? And what is a top strategic goal they should be thinking about?
Yeah, and I feel like from our work on the consulting side, we've seen many iterations of it, right? We've worked with CVCs in the beginning, and then when they see that they had the right idea, they changed their strategic perspective a little bit, or vice versa. They came in thinking one thing, and that was not effective, so they had to, move in a different direction. So I say that for those that are starting out, it's okay to take it step by step because you have to be agile and you have to be able to pivot if listen, we see this now, the markets have changed, even from 10 years ago or 5 years ago, so the firms might have to, readjust. But overall, I would say to try and build this, we talked about this on the webinar, go slow and really think about what your mandate is and make sure that your compensation structure is aligned with that, because it's very important to plan out as much as you can ahead of time.
I think there are two golden nuggets in what you just said. One is take your time. It's okay to make mistakes. Try to go step by step and iterate. But one is what worked 10 years ago or even 5 years ago may not work today because the environment is so different.
Yeah, and even the VCs have this, and their portfolio companies have this. So it makes sense because you're not acting separate from the whole investment ecosystem, you're part of it. And so, despite the fact that compensation is a little bit different, the whole investment view and optics on this have to be flexible, because who would have thought that the fundraising would be so difficult, or that the AI innovation, right? And there were times where it was other areas that were extremely hot. I mean, we always track where there are pay premiums and what jobs are paying more. And you can imagine that AI within CVCs and VCs is definitely coming up as a question. But years ago, we never had these questions and we never had those job titles.
That's true. Actually, we just started with a full time intern for 1 year just about efficiency and AI tooling. So I think it's coming.
Yeah, so those are jobs that are new, and just like the CVCs have to be agile and pivot, so do we here at Thelander, right? We have to keep listening to what you all need and what's going on, because it really is a true collaboration. There is no one way, and that you have to interpret the compensation based on what the goals of the CVC are, and also who the team is and what their experience is.
Yeah. So I need to give a disclosure, which is I'm a happy customer of Thelander. So what I'm going to say is probably going to be important for the audience, which is when you start a CVC, it's very hard to actually understand the compensation of a CVC. Part of it is because you're part of a VC ecosystem. Part of it is you want to incentivize according to the right goals. What would be your advice for someone who needs to explain compensation to a mothership who has not ever done a CVC? So they don't really understand the carry model. What would be the tips you would give them to explain why it's different and why it makes sense?
It's such a great question, and it comes up all the time. And you forget that explaining this. So, corporate HR and compensation is very different than the private capital markets. And I spent 10 years learning this when I went to graduate school and got a master's in human resource. So I really understand where the pressure points are, because if someone had tried to explain this to me when I was early in my career, or I was, just trying to master the corporate compensation structure, I would have been hard pressed to understand what all of this means. So that's a period. So for those of you that are struggling with this, I understand why on both sides. So I think breaking it down and really understanding what the compensation levers are compared to the traditional corporate stock only, and trying to help educate the parent company or the mothership in terms of what these different compensation levers mean and how they're put in place is really important, and to go slow with it because it is complicated.
Yeah. I think what was really helpful for me was corporations understand benchmarks. And so to be able to show benchmarks for corporate VC was very helpful, because that's one thing that every HR would like to see is what are the benchmark for a given industry. And in your case, the benchmark are actually nicely sliced between geographies, asset under management, job titles, and so on. So I think there is a way where we can help with the translation thanks to benchmarks.
Well, that goes back, I really have to say that I worked for a defense business back in DC, and kept on with them because they had trying to commercialize defense technology as well. And I learned, and I kept that through Thelander the whole time, so I can understand how it makes sense to you, because our tables and how we structure the compensation is very consistent with a traditional comp structure, meaning minimums, 25th percentiles, and all of that, the medians, averages, also showing the different ways to slice the data. So it was built on a traditional comp structure. And I think probably today, had I known, I would have done it the exact same way. But I was lucky in that it wasn't this crazy system for
Mm.
people to look at and be confused. It was actually taking something that had no order, the venture and then of course when corporate venture started, and making sense of it in a way that at least there was a speed limit to understand, right? We don't tell you here's what you do in terms of seeing the benchmarks, but it certainly helps to normalize what's going on out there.
And there's one thing which I did not expect, which makes sense today, is when I started TDK Ventures, nearly all VCs will start by asking, how do you compensate your team? And clearly they want to know that to understand your behaviors. But that's something which you have to think of up front, because this is something which you VC ecosystem wants to understand as part of you being a CVC. Can you explain why you think that question is fair game and why it matters to VCs?
So you're saying that the question is that VCs ask how much to make.
No,
Yes
no,
and
not how
no.
much, but what's your compensation scheme? Do you have carry? Do you not have carry? How do you reward your teams?
Right. Well, in the VC side of the house, right? There's only reason that VCs get into this is at the end of the day, they want to make a difference. And in addition to, but tied with the risk is the reward. So that's a very clear barter system, right? They typically put money in for their carried interest. So that's why they need to know, because it will dramatically impact their lifestyle. And also, they're investing a long time into companies. And I think on the CVC side, it was acting more like a corporation. And so there were less questions around it, because compensation, I would say up until the last few years, has been more sort of taboo. But there are many states now that have you need to pay transparency has become more, I think, common and more acceptable. So I think there's more adoption to it.
Yeah. And this is where you have this challenge. So you talked about phantom or synthetic carry,
Right.
which I think is a challenge of trying to look like a VC, but not quite a VC, but something that's actually more manageable and controllable from the mothership as well. Have you seen good examples and maybe good guidance you could give to the audience?
So let's distinguish though the difference between, and I'm not a lawyer or a tax accountant, but the true carry means that you get a return on the portfolio, right? You invest in the company and you take equity. And the shadow phantom synthetic carry is some variation on that, where can be based on either the portfolio returns or an exit. Like there are a number of different ways that you could be getting that shadow phantom or synthetic carry. So it's a little bit of an adjusted version down from a true carry model. And so I think it's really important. You're asking great questions, and it's important to structure it, because you need to know exactly sort of what you will be owning and how you own it and what will happen if there's a liquidity. And as we touched on earlier, I don't want to get too confused here, but you have to be careful, because sometimes if the returns are so high, that may leave the CVC people in the potential position of making more money than the actual executives or the senior leadership of the parent company. And that is typically, there has to be some type of cap on that, because they don't like to see that.
Yeah, yeah. Which is back to that matching between the two worlds.
Yeah,
And maybe
exactly.
that leads to one question, which I think from your vintage, from your point of view, I think, and having seen for more than a decade, you probably have seen quite a few mistakes. And clearly, and not having caps is probably one of them. Can you share maybe some of the mistakes to avoid so that the audience can think about, okay, I need to avoid this, I need to avoid that?
I think the number one mistake to avoid is to assume that it will all work out, and that you don't have to be formal and look at every possible angle. And I
Hmm.
think there are some really great lawyers out there. We had one on our webinar, and as I said, we also worked with DLA, and I mean, there are a lot of great lawyers out there. and they are a handful of really good CVC lawyers. And I can't recommend enough that you've got to really make sure that you have all the table stakeholders participating, because assuming that that will be taken care of, something will be taken care of later, is a heavy lift. And to work your way up that hill in a blizzard and hope that you're reaching some plateau where everyone's in agreement is harder than you think.
And I think there is something very different, in my view, between VC and CVC, that VC by design are very, very stable. Typically, people stay in the same VC for a long time. They have committed their own money. There is a carry that they want to earn. While CVCs could be a transition for someone from an executive. The CEO that maybe they report to could change. The head of the CVC could change. So there are many things that could change. And if it's not captured well, you end up with challenges. So when you say be careful, don't assume everything will work out, maybe one thing is also don't assume that the people who have agreed verbally will be there when it happens.
Well, that's a load. Okay, there's a lot of layers to break down here. So let's go slow on this. One is that VCs do have higher retention at the top levels. And we survey this
Mm.
because all these questions that have come up, you know the answers, but it's really helpful, as you said, to have benchmarks and data on that. So we do see that the top investment professionals, like we have like 6 levels of investment professional, from the senior managing partner down to associate, with senior associate and a couple of levels in between on the venture side. And just to say this is that the nice thing about the data that we have is that the VC and the CVC data, while it's two separate sets of question, it's on the same platform, because we want you, and we think it's so important to be able to compare and contrast. Like, it's
Mm.
important to know the answer to what you're saying, even if you're a CVC. So that's why it's bundled together. And on the VC side, you also see that the capital contribution is more so at the top levels than at the junior levels, right? And then we also do a lot of comparing of the VC and CVC jobs, like associate and analyst. And there is quite a bit of movement in VC as well as VC to CVC across those level of jobs. And so that's really important to acknowledge. The top levels at VC, yes, they are somewhat golden handcuffed, because
Mm.
there are a lot of capital contributions that come up. We show the vesting times are now over 10 years, moving away from that 5 to 6 years. And in many cases, they even further say you have to be present to win, meaning you don't always take your carry with you. Those are done on a case by case basis. Now, on the corporate venture side, it really depends. And you captured this perfectly, right? Because in some cases, they don't even have a carried interest model. You have corporate stock. So it's harder to tie people to stay because they're not as motivated. So if you want a different kind of longevity and you want lower turnover, then adding in some of those handcuffs that are tied to a vesting time and a carried interest and being present to win, which again, we ask all these questions, then you can. And that's why, listen, the data is only as good as you know what to do with it, because all of this is very tricky and there is no one way to move these pieces around.
And it's very interesting because if you think about VC, it's extremely stable in terms of compensation. You have a base salary. I don't even know if it's the majority have a bonus structure, and then you have a carry, and that's basically it. But if you think about the corporations, you mentioned stocks and of course base and of course bonus, but you also have synthetic carry, and the synthetic carry could be so different between one CVC and another.
Right. Although I have to laugh, because if someone's listening to this on the venture side, I'm sure they're like, no, that's not true. Because
Ah, okay.
it really isn't stable on the venture side. Across all VCs are not created equal, right? And it also depends on what the assets under management are. And it depends on the seniority of the team. And it depends on a lot of things. And it also depends on what your structure is, whether you are very carry intensive or you're cash intensive or you're both. So, I mean, we work on a lot of VC projects, and I can guarantee you no two have ever been alike. I think the levers are different on the
Mm.
CVC side, and maybe there are more levers to play with. That's the part that's more stable on the VC side, but how they're used, no recipe is exactly the same.
Okay. So if we go back to the CVC and we think about the levers, what do you think are the levers which are meaningful for success?
It really depends on what the strategy of the CVC is. Are they some financial return? Are they just technology transfer? Do they want innovation for the parent company? So that matters. And then we've seen in looking at the data that it also really depends on mostly on how the CVC is structured. And that matters in terms of like whether it's an off balance sheet, whether they have an allocated fund. And the more independent they are from the parent company, if that makes sense, the more typically they also have incentives that are tied to the success of the portfolio.
Yes. And if I go back to any other mistakes you can think of that you want to warn the audience about, is there anything that comes to your mind?
Really just again, assuming that let's say you have a separate balance sheet and you want to have as much autonomy from the parent company as possible. But in the beginning, the parent company may say, we're going to refresh this fund on a, every 2 or 3 year basis. And if you're not formalizing the compensation as early as possible and how you're going to extract yourself from the parent company, I think that again, it really comes down to the planning. The other mistakes we've seen is that you hire a lot of people only from the parent company and not as many people from outside, and it gets hard to stay having a corporate venture firm. Like you're not seeing any kind of sustainability from your portfolio.
Now, would you have a golden ratio between internal and external recruitment?
We really don't get into that so much in terms of the structure of the CVC. We get more into how people are compensated. But in terms of the number, it really depends on the CVC and the type of parent company you have and where they are in terms of, what they do. Maybe you're probably better suited to answer that from TDK Ventures in your past, whether you think there's a ratio.
I think it's back to what you said earlier, which is it depends on the goal. And if I was to abstract as much as I can between an exploitation of the current business and an exploration, I think if you're in the exploitation goals, you probably want maybe two-thirds to three-quarters internal recruitment and then some
Absolutely.
with good experience of the venture capital side. And you probably flip the ratio if it's more of an exploration. So you still have a good tethering to the mothership, but you're not biased by what you can't do because the intention is exploring what you haven't done yet.
And also, I totally agree with that. I see the flipping part where most of the CVC comes from the parent company. But then once they start to hire people from outside, whether they hire people from the investment banking or they hire from venture, then they sort of get wind of all the other options out there. And I think it makes once that color's in the water, you can't take it out. And then I think that sort of breeds optimism and hope and a little bit of a hunt to be more that way. And I see it flipping too. I don't have exact numbers, but I see that happening because that's where they typically call us and say, okay, Jody, now we want to understand the comparing and contrasting of the two sets of data.
Now, of course, we can't predict the future, but if I think about 2020, 2021, I think many people in CVCs thought the going to VC made a lot of sense. And you alluded to that liquidity window taking longer and longer. And now it nearly feels like many VCs actually are quite tempted to go to CVCs. So I think there is something about a delay function between the good exits and when people should be moving. Do you have a view on that?
I totally agree. I think CVCs are a great professional opportunity because it's consistency,
Mhm.
especially. And this is sort of counter to what we were saying is that the if there's a mix of corporate stock and some type of shadow, phantom, or synthetic carry, you still get the corporate stock, which offers uptick every year, and you don't have the pressure of fundraising potentially or a capital contribution. So there are pluses to both sides for sure. I think where the biggest challenges for VCs to go to CVCs, where we look at our numbers, is that they can make a lot of money in terms of their cash compensation. And some of that is because they made a capital contribution, but they got used to it, that mindset. And I think most CVCs have a traditional comp structure, and that they're somehow comparing and contrasting between the parent company and the investment arm. And so the total cash between base and bonus is not quite as high as it would be for those top jobs. I think it gets more consistent from the mid-level down.
Hmm. I think when we think about autonomy, you mentioned autonomy earlier, and you said there should be a right level of autonomy at the beginning. That's very complex, right? This is not something that's easy to explain and define. How would you think about the word autonomy from the mothership in a way you can deliver on your goals?
Well, it's very hard for a CVC to be sustainable, in my opinion, from what I've seen, if they just have the comp structure from the parent company. So that is probably a really good thing to be mindful of if you're starting a CVC is where do you need to be different? And what are the goals? And to really think about that. Because from what we've seen on the consulting, when people come to us and say, Jody, we're frustrated or we're not able to attract people. And we're also not, and that has a ripple effect in terms of participation in co-syndicating in deals, right? Because
Hmm?
the top VCs want a caliber of a CVC that's bringing knowledge and the resources from the parent company, but they also want solid investors who understand, because we also look at whether they have board seats and how active they are with these portfolio companies. So you really got to think down the long game of this, because the more tied you are to the parent company compensation, it is going to impact the type of investor that you're going to attract, let alone retain.
Yeah. I think that's a golden nugget, which is if you're not thinking about compensation and how it's different, you're not going to succeed.
Yeah, I mean, you want that innovative mindset and that risk taker. It's just a question of how important those different levers are to the people that you're attracting.
Now, there's one thing you mentioned which is so important in VC and part of the CVC mandate probably is a boardroom and being on the board of the companies you invest in. And there is, of course, a granularity between being an observer to the board and being a
Right.
director of the company. Can you speak to that and what are maybe the watch outs?
I have that data, but I didn't look at it because we do ask those questions about how many board seats you typically have and whether you're a board member or an observer. And the nice thing is, which makes I love to hear this, even to say it out loud, because don't forget, we do a lot of work with the portfolio companies as well. So we see this in effect, right? Because we work with the portfolio companies on their compensation, and then we prepare them or a board deck. So we know what everyone, and then oftentimes I'm on those board calls. And I would say that everyone is in agreement that you obviously want to make sure as a CVC that your skill set is being, or as a CVC unit leader or a senior investment professional, those are typically the two roles that are on the boards in one way or another. And obviously, the strength of the CVC is that you are translating the skill set of the parent company and using the resources that you have to help this portfolio company be successful. And from the portfolio company side, they're counting on that as well, because they distinguish when they say to us, we have a board meeting and our investors are, and they list them. And they specifically talk about having a corporate, and they're proud of that because they know that that gives them some competitive advantage.
Now you've been on these calls with in boardrooms. So is there anything you think CVCs tend to do better in the board and worse in the board?
I don't see anything worse, because
Okay.
obviously they don't bring someone junior from a CVC into a board, but what they do better is they're very collaborative. They're very founder friendly, and they're very collaborative with the portfolio companies. And I know that the portfolio companies rely on that, and they're, thrilled to have that level of collaboration and support, because it really, in today's investment community and investment sort of time frame that we're in, with companies are taking longer to raise capital, and then when they do raise rounds, they, as one of my clients said, the investors are taking their pound of flesh, so it's all very costly to everybody. And in addition to that, the funds themselves, when they're deploying capital, and they have the dry powder, but when they're deploying this capital, they're thinking very carefully about the portfolio companies as well. Like everyone's vetting. It's taking longer, they're more careful. And I think the CVCs have a really, strong contribution that's different than most VCs. Although VCs now have really learned from the CVCs and they're hiring people who have been operators. And a lot of what CVCs have done well is not uncharted territory for a venture firm anymore.
Well, you heard it. Some VCs learn from the CVCs. That's quite cool to hear.
We can see it on the list of jobs that we survey because it used to just be for VCs, it was investment professionals. And now we can see as the CVCs have added all these business development people who work between the parent company and the investment arm and also the portfolio, that the VCs have incorporated many of those jobs because they find it to be a value add.
Very nice. So I think you're making a good case, at least on the boardroom, for entrepreneurs to consider CVCs to join their cap table. We do have entrepreneurs watching the podcast too. So, what would be your advice to the entrepreneurs? What questions to ask a CVC before they decide to invite them or not to the cap table?
That's a great question. And I'm no expert at this, but I would recommend that they ask, like, what is the goal of the parent company and what is the goal of the CVC and what's the dynamic? Because if they are going to, in some respects, if the portfolio company wants to be acquired by the parent company, and they know that that's the goal of the CVC, that's different than a CVC that's really more weighted in terms of, some kind of financial return.
I completely agree. I think you can have any goals you want, but you have to share that goal with the entrepreneurs and with the other investors. I think there is no goal that's bad, but there's a problem if you're not sharing it.
Exactly. And the prep for, I would say, for the portfolio company or the entrepreneurs that are listening to this, knowing that and making sure that you're aligned up front is really important. And I just think part and parcel of what's going on today in the global capital markets and the sheer amount of time and money that it's taking to get funded, that I think these questions are being asked.
No. Now, I want to go back to this. I think it's very fundamental, which is, and clearly AI is maybe a separate topic, but if we look at the very best companies used to go IPO, now they stay private much longer. They may not even go IPO. I mean, look at SpaceX, OpenAI, and others. I don't think they have plans to go IPO unless something, but I don't see it.
Right.
And for VCs, that's very difficult, but you start to see secondaries. And I don't know if you start saying something about compensation and secondaries starting to play together or not.
Well, the secondary market is very viable for both the VCs as well as for the portfolio companies because, especially for those early employees that had equity at a lower price but they want a liquidity, there are other ways to do that other than an IPO or an M&A transaction.
Hmm.
You probably know better whether that is happening inside of CVCs. I don't think that a CVC firm can probably use a secondary, right?
We do.
Oh, you do,
So
see?
yes, and part of it is because like any groups inside a mothership, you want to show cash returns at some point. So I think that if there is an ability to do secondaries, it becomes a strategic decision whether to take advantage or not. But you're right that it had been the case where it was purely IPO, M&A, or goes to zero as
Right.
the only outcomes being available to a CVC or a VC. And now secondaries are becoming an option.
Yeah, I mean, it is another vehicle, sort of an on-ramp and an off-ramp, but there's no question in my mind, having been doing this now for close to 30 years, that this too shall pass, and what's in favor today may change in 5 years, and at some point, the markets will open up in a way, but maybe was just and you and I talked about this with AI companies.
Mm.
There's a lot of talk about a lot of money going into AI companies. Not every AI company is going to make it.
I mean, statistically, it just can't happen. I think it will probably follow the same power law we see for every other early stage, high risk type of investments.
Yeah. And I mean, we do a lot of work in life sciences, and that's another area that's always going to be around. There's always going to be people that are, looking at patient care or longevity or health and well-being and cancer research. That is an industry that's never going to go away. And it's never really been, I mean, it's so funny when we do consulting on the private company side, they say that their investors want us to look at the comp data, some by total financing and industry. And then that's always the life science companies versus the tech companies are more revenue oriented. So there's no one way.
I think it's interesting because if I think about medical companies and drug companies, they actually follow more the VC type of mindset of getting their investments, and it's a type of power law type of outcomes as well. Very few drugs will make it all the way to the end,
Right.
and you have increasing amount of investments. So I nearly feel like the drug companies are already in the VC mindsets because of the way they see the outcomes, versus the non-drug companies, the tech companies, where it's actually more on a distribution type of law.
Right, because most pharma companies or smaller companies on the biotech or the device that are bought or acquired do not have revenue, but it is the prospect of the drug that the parent company of the CVC could not have done that type of research and clinical development, and they do that because the portfolio company or the company is been very successful or successful enough. But on the tech side, they really want to see something more substantial.
So I don't know if you have the data or if you know that, but I mean, my hypothesis would be that pharmaceutical company are more VC mindset ready, and therefore they would understand compensation better than non-pharmaceutical company. Have you seen this kind of dichotomy, or am I just having a wrong hypothesis?
It really more depends on the role of the investment arm of the for the CVC unit and how they're structured in relation to the parent company, and
Mm.
less so by industry. Even on the VC side, because we do work with VC investors that are life science oriented, and many firms have life sciences and tech, and we don't see a difference in compensation depending on the investment area in those types of firms. But there is a certain premium, make no mistake, on the life science folks because they are typically extremely well educated, either an MD or PhD or some combination of MBA and a medical degree. So there is a premium if that was the only, criteria against just a pure tech person. But there's exceptions.
All right. What are the best exceptions you've seen?
Someone who is just a baller who's been so successful, they write their own, they want cash, they want carry, or they want cash and then they want corporate stock and some other incentives. There are those people who have just done really well and they set their own rules, and there is no correlation between more cash, less equity, more cash, less carry. They are at the top for everything.
And I think that's part of why in your benchmark you're not just showing the quartiles, you're also showing the maximum.
I love the maximum because the maximum we go through we spend the most amount of time on the least amount of data. We look at, well, now our system sort of catches it, but when back in the day, I personally used to look at every one of these numbers, and it was so fun to do it because it really helped me understand what was going on. And in a lot of cases, I'd call the company or the firm and say, "Can you explain this to me?" Because we want to make sure that we're not using outliers, but that we're
Mm.
really using true maximum numbers that exist. So we like to see at least 2 or 3 or 4 data points hovering so we know there's a cluster. But
Mm.
yeah, for sure. I mean, and that's probably a good way to, tie this together. For those VCs that are going to CVCs who are thinking really big for the parent company, and the parent company wants to be innovative as well. They're making a lot of money and they're using the venture model.
Yeah. I remember you did a webinar last year where you actually explained the maximum used to be maybe one outlier. And now they're more like a group, a small group, but a group of gravitating around the maximum.
It never was a single data point that was out of whack. Like, let's
Um,
say that the maximum number was $1 million for someone's base pay, and then we had a data point that showed 5 million. We would drop the 5 million if the next number down was a million. But if we
Oh,
drop
I
the
see.
million, then the next number is 950 or 925 or 875. Then we keep the million. So anything that was a standalone that made no sense, and then you dropped it, and the next number was significantly lower, we would always make sure that was not what didn't stay.
Oh, that's a good to know. I did not know that, so
Yeah.
that's really helpful.
It can skew the data and, and it skews the median numbers as well.
Yeah, which doesn't help.
No, we do the same thing on the minimums. That's actually, I really appreciate you asking this question because it's important that the data is clean and that there are levels. And we've had to adjust this over the years, over these 10 years, because we used to have, for example, just an associate, and now we have a senior associate. We used to have just an investment professional, and now we have a senior investment
Mm.
professional. And we really had to hone in on these lanes because while one CVC firm may have a title, it may not match with the title of another CVC firm. And you can't just throw this all in the pot and hope for the best. So we take a lot of time to make sure that it is leveled. And if we might have to move somebody's title either up or down because of where they are on balance with the market, then we do. I mean, we have a discussion with the firm or the individual, but we want to make sure that the data is giving you a true sense of what's going on.
It's very helpful to understand you're not taking the data at face value, but you challenge. Sometimes you call the firm, you try to understand what's happening. That actually is really helpful to know.
Well, it's true. And we've had this discussion in our discussion is that not all CVCs are created equal. Some are, with smaller parent companies and just looking to be keeping a handle on what's going on in innovation. And some are really, co-brand, co-syndicated and part of deals where they are really at the top of the innovative ecosystem and food chain. And so the compensation, as you can imagine, for those CVC unit leaders or senior investment professionals may really vary.
Yeah. Now, in last week webinar, you were presenting some data which I thought was very interesting, which is of all the CVCs in your data set, half of them pretty much have some type of carry model, half don't, and it's quite stable year over year.
Right.
Um, what's your takeaway from that?
I think that's great. My takeaway is that the CVCs are really a prominent player in the investment world, and they have to be tied to the success of the portfolio company in some way, not necessarily the same way as the VCs, but they it's important that that their compensation is tied to the same success of the exits or what the portfolio company accomplishes.
I really like the way you frame it because if your portfolio is successful, you will bring more strategic value. And if you make bad investments and they all go to zero, no one can argue you brought strategic value. But if all of them becomes this $1 billion valuation, revenue generating, market leaders, you're going to bring massive strategic value.
Yeah, I mean, even on the VC side, there has been a little bit of a nuance, not only with secondaries, but also with equity distributions. And if we worked with also private equity clients, we see that they're trying, knowing that the carried interest takes so long to return a whole fund, that they would like to have a distribution if possible, and if there's a success of a portfolio company.
Now, if I shift gears towards recruitment, so clearly you need to think about compensation for the team that's already in place. But if you think about recruitment, and here with the granularity of internal and external, how should how should someone who's leading a CVC think about it?
Well, I will preface that we don't recruit. And I think it's really important because by people giving us their comp data and getting data back, we are very careful not to double dip. And that was a decision I made early on because we didn't want to be using that same data sort of against you to then recruit your people. So, probably not as much my area of expertise, just that I think we touched on this that if even if someone comes from the parent company and they're used to that comp structure, sooner or later, they're going to have a discussion with their colleagues or with people that they're co-invested with, and it's going to come up. And you sort of want it to come up because you want them to be motivated by the success of the portfolio in some way.
It makes sense. And now in terms of retention, so you recruit the team, now you want retention. What's the best practice you've seen in terms of explaining it to the team, not to the mothership anymore, but to the team?
Well, I'm a big proponent in transparency and having honest discussions and being knowledgeable on what's going on in the market, why you chose what you chose, and then where somebody is getting paid. Because that sends a clear message. It's not that different than parenting. Listen, we know what the other kids are doing. Here's what we're doing in our family, and here's what you get. So it's, very basic because that way if it makes someone happy and they like that, they can stay. But if they feel like it isn't a representative, this comes up all the time when someone's getting paid very well and they're happy. So then you don't really have a conversation about compensation. But if somebody's not paid competitively and they don't feel like they're getting paid what their worth is or their value of their contribution and skills, then that requires a conversation. And if the answer is that this is where we see you, then you get to decide whether that works for you or not. And I think the more a CVC and the leadership has this planned out and having these conversations is not a problem, then the better suited you are. And I think that really goes back to what we started with. You've got to think about it all because you can't just hire someone and think you're never going to have that conversation again.
No, that makes a lot of sense.
We see the use of spot bonuses more and more than having the formal bonus programs as well, that if someone does something well, they want to be compensated for it. And the shorter term incentive is the bonus because that happens throughout the year versus these other incentives usually have vesting times and are longer term focused.
Do you see spot bonuses more frequent in times where you have very little exits versus more exits, or do you see them happening on a regular basis?
We see them happening on a regular basis. Now, the size of the bonus may vary depending on the success and how much money there is, but from the mid-level down, right? Someone at a director principal level in a venture firm down, senior associate, associate, pre and post MBA, and also in a CVC, they are more cash compensated anyhow. The bulk of the carry or the other incentives go to the more senior jobs. And it's also true inside of a portfolio company. The CEO and the founders and the other chiefs and VPs have the bulk of the equity. So and that's why these jobs are really competitive across all sectors and all landscapes and all geographic locations. So because they're more cash oriented, those bonuses and those cash bonuses can be very meaningful. And if you want someone to stay, then that's what you've got to do.
And do you see the spot bonuses having a vesting, or do you see them more as really spot at a given point in time?
Yeah, they're cash.
Yeah, yeah. I like one thing you mentioned about your product, which is you bundle both the VC and CVC so that everyone gets to see both sides. Can you maybe share the philosophy behind? Because I think that's very profound.
It's so important. Well, we started, as I said, doing the VCs. And by the way, on the VC side, I think we started with like 10 or 15 jobs, and now we're up to almost 80 positions, similar to
Wow.
what's happened in CVC. But the ability to compare and contrast is really important because you can't just go through this with blinders on. You got to know what's going on around you. And then you make your decision about what makes sense for you.
Yeah. I know that when we designed our compensation model, I was very, very clear that what I was worried about was to lose my team to deep tech tier one VCs. I wasn't worried about CVCs per se. I was more worried about VCs. And to have a view of not just CVC's compensation, but VC compensation was really important.
Yeah, it is. And also, and we are very global now because we've done a lot of work in Europe. We've done a lot of work in the UK, and there is definitely a competition for talent. There is more going on in the UK is very forward thinking in terms of innovation and trying to make sure at the especially coming out of like Cambridge and Oxford, the life sciences. And so, and I like now everyone always would go to the JP Morgan Healthcare Conference. Now the Jefferies Conference in November in London is very, well attended. So you got to be aware of what's going on globally as well. And our data covers all of that. And it's nice for us to be able to look by geographies within the US as well as outside.
Very nice. Now, we talked about our friends at GCV. Can you make the case why GCV is so important to our ecosystem for those who may not have gone to GCV yet?
I haven't been to GCV in a couple of years, but from what my experience has been, is that it brings together the industry. Um, I don't know if it only brings together the leaders, but it also helps teach. And I think there's a very strong component about the teaching piece, and that is what GCV does. You're probably better equipped to answer that,
Yeah, no, we had Liz recently sharing about the GCV Institute, which I think
right?
is also very helpful for teaching best practices and getting people to really even understand the difference between being an observer and a director of a company on the board, and what are the fiduciary duty and confidentiality duty and all of that. So
Yeah,
yes.
Liz is great, and we have worked with her for years. They always provide us content for questions, and I know that they have a wonderful relation with GCV, who's also just been an integral part of the CVC infrastructure.
Now I'm going to challenge you on thinking about two different paths. Someone in a VC thinking about joining a CVCs, what are the pros and cons? And then I will ask the vice versa.
If someone in a VC is looking to have, impact and have more resources, that's where I think a CVC, and that the fundraising may
Mm,
have gotten harder, and that they're with a VC firm that is maybe at a certain asset under management asset class, it's a little smaller, and they want to have more opportunity and see a bigger bigger picture in terms of the strategy, and incorporating the skills of the parent company. That might be an opportunity for them.
I love that answer. I think that you're right. It's about potential for impact, taking the resources which you don't typically have in a VC, and being able to bring so much more superpowers than you would typically have. I really like it. Now, if you're in a CVC and you're thinking about joining a VC, what would be the pros and cons you would make?
Well, I think you probably have learned a lot in your CVC, but now you really want to you feel comfortable about your investment strategy, and you really want to have skin in the game, and you want to have just a true cash and carry, and you are happy to contribute capital, and you want to really be on that, with maybe a firm that has had a track record of success. And you've had successes, but your compensation maybe has some boundaries in terms of how far much you can participate in that, and you're ready to go.
Very nice. So, Jody, my last question for you would be more about your hope for the future. How do you see the CVC's professionalization moving forward? How do you see the impact it can bring to entrepreneurs and to their mothership?
I mean, it's all moving forward. CVCs have done a great job, and they continue. We have the pleasure of working with many, especially like relationships like yours, Nicholas, that have been a long term, right? It's been since this all started. We remember each other from 10 years ago. So I imagine in another 10 years, we're going to know and see even more. And CVCs are going to continue to be a very important part of the investment ecosystem, and the innovation, and that end to end solution that they provide to portfolio companies is unparalleled. And I think that we're going to continue to see that the CVCs are coming up with even more innovation and faster, because they're going to extract from the parent company.
All right. It sounds like you're very, very bullish on the CVCs moving forward.
Yeah, absolutely. I think it's terrific, and we're really glad to be part of that, of your team, and to be able to have the comp data to understand. And it's really the relationship back and forth that has been invaluable. So anything we can do, just let us know. And thank you for having me today. How impressive! You really are the corporate venture insider.
Thank you so much, Jody. It was really nice for you to share very openly, candidly, all these insights and how you see the industry. So, thank you so much.